Interest rates are on the way up, so we're here today to tell you what you can do to prepare. Hi, it's Marissa and Tarkan from Rise High, and thanks for joining us. Obviously in Australia we've had historically low interest rates for a few years now as a result of COVID, but it's very clear to see that interest rates are moving up. Are you seeing this now,
They
Tarkan?
certainly are. The fixed rates are moving up at a rate of knots.
Yeah, and it's not going to be long before the variable rates are also going to move up. So what does this actually mean? Well, it means that your mortgage repayments may become more expensive if you're currently on a variable loan. So today, Tarkan and I are here to tell you a few things, give you a few tips on how you can prepare yourself for rising interest rates. So Tarkan, what's one of the things that you're suggesting to clients to prepare themselves for the inevitable interest rate rise?
Well, ultimately, Marissa, the old saying goes, make hay while the sun shines. We're dealing with that at the moment, but we're coming to the end of that point now, as Marissa has said. So, we'd suggest certainly start increasing savings, possibly increase the amount of loan repayments, because by doing both and possibly with increased savings, utilising offset accounts and things like that, you can limit the amount of exposure you have to the interest rate increases, which are coming.
Yeah, I really love that idea of increasing your loan repayments now. So one of the things that you could be looking at is almost speaking to your Rise High mortgage broker now to predict what your repayments will increase to if there is an interest rate increase. And you could actually lift your repayments to that level now, so that when there is an increase, it's not going to be so much of a burden. I also love the point about increasing your savings. We always like to encourage clients to try and build a savings buffer that would equate to 3 to 6 months of their living expenses, so that if something unfortunate or unexpected happens, they're not going to be caught out from a savings perspective. They're going to have a nice buffer there for emergency.
And it lowers the anxiety around the repayments as well, so that if you are going through something, you can focus on getting through that, as opposed to worrying about when it's coming back, or reducing your quality of life. Everyone loves a coffee. We don't want to take that away from you. So it's just preparing for things like that.
And I think the better prepared you can be, the better you're going to manage the situation when it does come. What's another tip that you're giving clients around preparing for rate rises?
Well, at the moment, the fixed rates are, as you said, at an all-time low, but they are creeping up. We have noticed that certainly over the past couple of weeks. There has been significant increases. So the lenders in the market are expecting rates to go up pretty soon and pretty quickly. So we would say maybe explore the fixed rates. At least then you've got consistent repayments and you can budget around that.
I think that's the key to the fixed rates. It's not really about out-predicting the market with fixed rates. It's more about having that certainty of repayment over that fixed term, so that you actually have that comfort and can sleep well at night knowing what your repayments will be. The reality is, many economists have their predictions on how quickly the rates will rise and at what pace, but we really don't know. There's so many uncertainties ahead in terms of how quickly the rates will go up. The only thing that we are certain about is that the rates will go up. When that will start and how quickly that will happen is still sort of unpredictable. So if you do want that certainty and you like to know what your repayments are going to be over a fixed period of time, then fixed rates are a good option to explore, and you want to get in quickly before they go up too much more. What's something else that people can do to prepare, Tarkan?
Well, looking at probably external dets as well, debt consolidation, credit cards, personal loans, car loans, they're all extremely hefty interest rates as well. So, allowing yourself to save through not having to pay those.
Absolutely.
Even though, as I said, we're looking at the mid twos and into the threes with rates at the moment. That's still pretty good compared to what it has been and what it was probably 4 or 5 years ago as well. So,
well, that's right. We've got to keep remembering that long-term interest rates are, a long-term average interest rates in Australia between 6 and 8%. So when we're talking at rates now below 2%, well, obviously they're going to go up. But I love your point about credit cards and personal debts and consolidating those debts, because obviously a rise in the interest rates will ultimately mean pressure on your cash flow. So if you can alleviate cash flow pressure from other areas, so reducing, personal loan or car loan repayments, even things like explore your afterpay and any of your buy now, pay later type debt or short-term debt, we can try and save on the cash flow there that will help provide the cash flow to your mortgage repayments.
Yeah, absolutely.
I guess the other thing that I'd really like to point out is that if you do feel nervous about interest rates rising, or you do want to, you are feeling a bit anxious about it, or even if you just want to have a chat about it and just make sure that you've got a plan, it's really important to talk to us early. So don't wait until interest rates rise to talk to your Rise High mortgage broker. We're here to help you. We are your partners. We would love to have the conversations with you early so that we can help you to prepare and make sure that you and your family are really secure and confident going into this next phase of interest rate rises moving forward. Thanks and have a great day. As always, we're here to help, so please reach out whenever you need us. Thanks. Bye.
See ya.